My guest today is Lou Mendelsohn. He's a pioneer in trading software. We're here talking to him about his history and how the evolution of his software led to today. So Lou, you started ProfitTaker, which was very unique in its day, and you had to jump over a lot of hurdles to make it work on a PC when all of this stuff was being done on mainframes. What was the next evolution after ProfitTaker? What did you do next?
Well, of course, immediately after ProfitTaker came out, I was involved in marketing it and dealing with the industry. And I was very involved in writing articles and contributing to books and speaking at various industry conferences about strategy backtesting and the innovations that brought to the industry. At that time, of course, a whole number of other traders like myself began to also become software developers, many of whom were actually customers of mine, who had cut their teeth on ProfitTaker and then went on to develop competitive products. So that's really the beginning of the commercial trading software industry. Prior to that point, when I was working on ProfitTaker, it was really a cottage industry. It was individual people like myself in their bedroom, in their living room, pecking away on a computer, developing software. Then it evolved eventually into a real industry, as I would consider it. In the mid-'80s, around 1986 maybe, through my trading, because I was an outright trader, and I also did a lot of spread trading, a lot of currency spread trading. So that was back when the Deutschmark existed as a market. I used to trade the Deutschmark, Swiss franc a lot, and so I was very attuned to the relationships between markets, the intermarket relationships that existed in the marketplace. And that, I think, is what really got me thinking about the influences of other markets on a particular target market that I was trading. And I mean, this was just intuitive at the time in my mind. I had nothing tangible to substantiate my thoughts, but it was just an intuitive idea that I've got to move beyond single market analysis, which is what all the software programs at the time were involved in strictly doing. And even today, most software only looks at individual markets and does whatever technical analysis gets performed on that individual market and so on. But I began to instead look at it from a much broader perspective. I mean, I had a background, as I said, from Carnegie, a lot of background in finance and in economics and so on. So I was always interested in global economics and looking at things from a global perspective. But I hadn't yet thought about the globalization of the markets, because at that time, no one was thinking about that. The word global economy didn't even exist. And so I started to slowly but surely start working on software that would begin to make inroads into market analysis and how markets influence and affect each other. And and then of course the '87 market crash, which was a global phenomena, that really drove home to me the fact that I was really onto something and that I really needed to continue to pursue looking at the markets from that global perspective.
So if the first breakthrough was using computers for the software, it sounds like Intermarket Analysis was almost your second breakthrough.
That was a second breakthrough.
So how quickly did you implement that into software and say, how can I bring this in as well?
The first program that I came out with was around 1988, just after the '87 crash. And it was a spreadsheet format, kind of a two-dimensional spreadsheet that looked at markets, influencing markets in a target market, but it was just two-dimensional, and it just basically said, like if these markets go up, then this market goes up or down or whatever. But it lacked the rigor that I was looking for in terms of the quantitative aspect of it. I couldn't really determine how much the market would go up or down. All I could say at that point was that it would go up or it would go down. And I wasn't really able to take into consideration the simultaneous multiple effects of these other markets on that target market. It was primitive, and I wasn't satisfied with it. And so while I did produce it and clients used it at the time, I was already yearning for something more rigorous.
You were looking for the specific correlation percentage. How well is this market correlated?
Not correlation, no. It was correlation, again, is from my perspective at the time was too primitive. I was doing that when I was a spread trader years earlier. I'm looking for multiple markets all dynamically interacting with one another, and how the combined effect of all of those dynamic interactions are affecting a given market. That's not a correlation. It's much deeper than that. So that's what drove me ultimately into looking at phenomena in the artificial intelligence arena known as neural networks.
Talk to me about the next step of trying to implement that into software, then to have your software look at that.
Basically, I had to teach myself about neural networks. And of course, I was continuing to explore the whole phenomena of intermarket analysis. So it was kind of like combining two different worlds, the mathematics side of the neural networks and the pattern recognition capabilities that neural networks presented, with the application to intermarket analysis and looking at multiple markets simultaneously, how they affect a target market, and how these dynamics can be discerned through the use of neural networks. It took me into a realm where, no longer looking at it from a spreadsheet perspective, two-dimensionally, it became a multi-dimensional matrix, so to speak, where you're looking at the different weightings that are occurring among all these different markets and how they're affecting your target market.
So you were still looking for a way to take it from lagging view of the market to forecasting again.
Yes, because neural networks had that capability. They allow you to find the patterns and the hidden relationships between variables or markets in this case, and then use that output, that outcome, to be able to make a prediction of what the target market is going to do based upon the behavior that has occurred in these other related markets. So it tied neural networks with intermarket analysis, with forecasting.
How did you kind of come to know neural networks as a possibility that this would do this? Do you remember, was it an article you wrote or read? Or?
It was just brute work, just literally trial and error and research. And at the time, of course, I was doing it, we didn't have anything computerized or anything. A lot of it was manual. I really was sifting through the information and seeing what works, what doesn't work, how to change it, how to modify it, check it again, see if it's better, and so on and so forth. At that time, it was just really all manual. Now, of course, we've gone so far beyond that. We have robots that do it. But I was fortunate because, again, from my background at Carnegie, my MBA, I'm not a mathematician, but I'm very comfortable with mathematics. And I also had the benefit of starting to put together at the time, it was really me and one other person, but that guy was a PhD mathematician that I became affiliated with, and he was able to help me push things along, much more quickly than I would have been able to if I were on my own.
Lou, thanks for being here today.
Thank you very much.
I've been talking with Lou Mendelsohn, a pioneer in software for traders and his evolution in that industry.